Hello everyone, welcome to our discussion on federal income tax formula. So here I'm showing you the federal income tax formula, but rather than just reading it out loud, what I'll do instead is I'll just walk you through this formula using an example. So in this example, it says that in 2026, Jordan, pay attention to the age of the person and also their filing status. In this case, their age is 31 and they're single. And it says that this person earns $80,000 in wages, $2,000 in interests and dividends, and receives a $2,000 gift. So let's begin by looking at the first step of our formula, that is income broadly defined. Here we can see that there are three sources of income. We have salary, then we have interest and dividends, and we also have gift. So we add the three up to get our income broadly defined here, which is $84,000. Now, the next step is to think about, are there any sources of income that can be excluded given the tax law that we have? So the tax law allows us to exclude income from certain sources. For example, if you have municipal bonds and then the interest income that you have from municipal bonds, those are not taxable. So you can exclude the interest from municipal bonds from your gross income. Gift and inheritance, that's another common exclusion item. Child support that you might be receiving, those are also not taxable. So they are not part of your gross income. Life insurance proceeds, if you are the beneficiary, then those are not taxable to you. If you sell your primary residence and if you make a gain, then under certain circumstances, you might be able to exclude the gain, and we'll have a separate lecture on that particular topic because that's a very important topic. Then, as part of your job, you might be receiving some fringe benefits. So, for example, employer provided health insurance or tuition assistance that you might be getting, those are also excluded. Then if you are receiving scholarships or fellowships and you are using the scholarship or the fellowship money to pay for tuition and books, then those scholarships and fellowship amounts, those are also not part of the income, so they can be excluded as well. And then lastly, another common item we have is Roth IRA distributions. These are tax-free to you. So in this example, we can see we only have one exclusion item, and that's gift. $2,000 gift that Jordan received. And that's why we subtract 2,000 here. That brings us to our gross income for Jordan, which is $82,000. So please pay attention to the difference between income broadly defined and gross income. And the difference is that income broadly defined includes all sources of income, whereas gross income excludes certain sources of income given the tax law that we have. The next step in the formula is above the line deductions. These are certain expenses that we can deduct from our gross income to arrive to our adjusted gross income. So now let's keep reading the question. It says he pays $5,000 to an IRA, 1,200 in student loan interest, 10,000 in state taxes, 4,000 in mortgage interest, and 2,000 to charity. Now, among all these expenses that we have been provided with, not all are above the line deductions. Some are above the line deductions and some are below the line deductions. But right now we are concerned only about above the line deductions. So let's learn about some common above the line deductions. One common item here is alimony, but only if you got divorced before 2019 and you are the person who is paying your ex-spouse alimony, then you can deduct that alimony amount as above the line deduction. But please pay attention to this timeline here that the divorce need to be settled before 2019 for these alimony payments to be above the line deductions. And we'll have a separate lecture on that. So we'll discuss more about alimony in a future video. Next, we have traditional IRA contributions. If you are contributing to your IRA, then under certain circumstances, those contributions can be above the line deductions as well. Again, I'm going to discuss more about that in another video. Some more common above the line deductions are student loan interest up to $2,500. If you are self-employed, then you are paying self-employment tax, and half of that can be above the line deductions. Business expenses, if you are self-employed, those can be above the line deductions. Moving expenses can be above the line deductions, but only for people who are serving as part of the armed forces. Lastly, we have self-employed health insurance and retirement contributions. These can be above the line deductions as well. So in our example, we can see that there are a couple of above the line deductions. One is $5,000 to an IRA and $1,200 in student loan interest. Again, that amount is less than $2,500, so Jordan can take all of it. So we apply that $5,000 and $1,200 to come to the $6,200 amount. That's our above the line deduction. So we're going to subtract this $6,200 from our $82,000 to come to our adjusted gross income, which is $75,800. So we have arrived at a very important point in this calculation because we have found our AGI, or adjusted gross income. The next part is to figure out our below the line deduction, and we need to pick one out of two options that we have available to us. One is standard deduction and the second is itemized deduction. So let's look at standard deduction first. Now, this information will be provided to you during your CFP exam, so you don't have to memorize these numbers, and also these numbers change over time. Now, because Jordan is a single tax filer, we just look at this row in the table. And for single tax filers for the tax year 2026, standard deduction is $16,100. So Jordan has the option to take $16,100, or Jordan can itemize deductions and compare the total itemized deductions against this 16,100. So if the total itemized deductions are greater than 16,100, then Jordan is going to take the itemized deductions. On the contrary, if these total itemized deductions are lower than 16,100, then Jordan is going to go with the standard deduction amount. So whichever is greater, standard or itemized, Jordan is going to go with the greater one. So that means we need to now figure out the itemized deductions. Now, these are some of the common itemized deductions. If you have medical expenses, then the expenses that are greater than 7.5% of your AGI, those expenses can be below the line deductions or itemized deductions. But please pay attention to this number. Not all medical expenses are itemized deductions. Then we have charitable contributions. Up to certain limits, they can be itemized deductions, and we'll talk about that more in a future video. Investment interest, that can be itemized deductions. Mortgage interest can be itemized deduction. And then state and local taxes that you might be paying. So state, local income taxes, sales taxes, property taxes combined, then those can be itemized deductions as well. But there is a cap, there is a maximum amount. For the 2026 tax year, that's $40,400. So that's the maximum amount, but not everybody will qualify for that amount. For higher income people, this number might be lower. Now, in our example, let's see how many itemized deductions we have. We have $10,000 in state taxes. We have $4,000 in mortgage interest, and we have $2,000 to charity. So these are our itemized deductions. So if we add them up, we get 16,000, and then we compare our 16,000 against our standard deduction amount, which is 16,100. Now, of course, 16,100 is greater than 16,000, and that's why Jordan will select the standard deduction rather than itemizing the deductions. So Jordan goes with the standard deduction, which is 16,100. That means we are going to subtract this number from our adjusted gross number to come to our taxable income, which is 59,700 in this case. The next step is we will apply the appropriate tax rates to this taxable income. And again, for this, we don't have to memorize anything. This table will be provided to us during our CFP exam. All we'll have to do is figure out where does this taxable income of 59,700 fall into this table. So let's try to figure that out. I can see that my 59,700 will be exactly in this row that's between 50,400 and 105,700. So my 59,700 that falls within this range. And then for any taxable income that falls within this range, this table says we have to pay 5,800. Then we are going to take 22% of the amount that's over 50,400. So because the rate here is 22%, that's why we have 0.22 here. And then we need to figure out the amount of taxable income that's above 50,400. So let's do that. So we take our 59,700 and then we subtract 50,400. That will give us the amount that's above 50,400. Once we do our math, we see our preliminary tax liability is $7,846. So that gives us our preliminary tax liability. The next thing we can do is from our preliminary tax liability, we can subtract any tax credits that we qualify for. So let's look at the question and if we have any tax credits. And the question does mention that Jordan receives a 1,500 tax credit. So we just subtract that number and we get our tax liability of 6,346. Now the next piece we have, and this is the last step, we can subtract the tax that was withheld from our paycheck. So in this case, for Jordan, it was $6,000 that was withheld from his paycheck. So once we subtract $6,000 here, that will give us the tax due. In this case, that's $346. Now, what if the amount withheld was $8,000? In that case, Jordan would actually qualify for a refund because Jordan's actual tax liability is $6,346, but his employer withheld $8,000 from his paycheck. And that's exactly why Jordan will qualify for a refund from the IRS, which is $1,654. So this brings me to the end of this discussion. So please try to internalize this federal income tax formula. If you don't internalize this formula, then you are going to struggle. And this formula is not going to be provided to you during the CFP exam. So please make sure that you are very comfortable with the different steps. Please pay attention in particular to adjusted gross income, taxable income, and tax liability. Sometimes they might sound similar to us when we are learning these concepts for the first time, but they have very specific meanings and different meanings. So please pay attention to the definitions of these terms and where exactly in the tax formula do they appear. And then when you work with tax related problems, please read the question carefully. If the question asks you to calculate AGI, then calculate AGI. If the question asks you to calculate taxable income, then calculate taxable income. So please do not confuse these technical terms. This is where I will end this discussion, and I hope to see you in the next one.